ARPG. I'm Garrett Lill. Pleasure to see you as always. Happy Friday to you.
Happy Friday. Uh, Great Friday. My daughter's getting married tomorrow.
I imagine it's been a very quiet and peaceful week around the Dahl household.
Yeah, not much going on at all.
Mm-hmm.
My house looks like Allegiant Stadium most of the time during the week. It's just full of people, with a drink in their hand or running around. It's been so great. I mean, talk about blessed. It's been wonderful. In fact, the rehearsal for the wedding is in 51 minutes from now.
Okay.
So we're all looking forward to that.
Yeah, I was told in no uncertain terms that this is a hard stop at 10:30 Pacific. So we won't be dragging this on at all. So we'll get to the point. So little bit going on in the market. We just keep plugging right along towards the Matt Dahl imposed year-end target 68, 69, 7,000. I can't remember exactly what the number was. I think it started 68 to 7 or maybe 69 and plus or minus. I can't remember how you I want to say it was 69 plus or minus 100, right in that range, but we're right on it. I mean, we're 1% away from it right now.
We're there. I'm sure we'll have a 7 handle before the year's out.
Yeah. Well, you gotta be careful with that. You say "I'm sure," that's going to get you in trouble with compliance. So we won't say that, but it looks likely.
It looks likely that the market will get to 7,000 by the end of the year. But hey,
there you go.
Anything can happen.
Yeah. So what's going on with the government shutdown and how's that impacting the markets? And I see some headlines on that. I don't follow it as closely as you do. So what's going on there and what's it mean for the markets?
Well, the biggest thing for the markets, we're not getting data. Like the jobs, we're not getting jobs reports. We're not getting the non-farm payrolls today. We're not getting any of those things. So now we have to rely on like the ADP number from Wednesday, right? That was a jobs report and it came in pretty weak. Consensus estimates for the ADP number was 50,000 new jobs for the month. Okay, came in at negative 32,000. Okay, so that's pretty ugly. That actually caused yields to kind of pop down. I think we're at 407, 408 yesterday. I think we're about 410 today. It went up size almost to 420. We got to 399 about a week and a half ago. So the 10-year is kind of in a new area, right? It was living in that. It was 420 on the low end to about 465 on the higher end. It kind of bounced a little higher for quite a while, and now it's kind of gone through that 420, and now it's living in sort of this 4 to 420 range a little bit. So we think it's going to continue to kind of melt down by the end of the year, and we think we're going to get to that 375 range by the end of this year, and it's going to be that coupled with these. Obviously we're going to be in a lower interest rate environment. We're going to have a much more dovish Fed going into next year. We have great corporate profits coming, strong earnings growth next year, which is going to propel us, next year. In fact, Bank of America, who I don't really regard as one of the better market people, their team, they're usually ultra conservative with their analytics and their targets and things like that. They never really go out on a limb. So for them to post a 7,200 number. 12. It's not by the end of this year or end of next year. It's a 7,200 number 12 months from now. So call it October 1st, 2026, 7,200. I think that's probably not too far off. There's a likelihood that next year will be more of a digestion type year. It could be. It's a midterm year. Again, if you take every 6 months and you chunk of a 4-year presidency, so you get 8.5 years of a 4-year presidential cycle, the first half of a midterm year is by far the weakest half of those 8. Okay, followed by the usually the second half of the actual election year, because there's so much uncertainty with and that's particularly when there's no incumbent. So anyway, so we're kind of going into that. We're going into that time next, just in a few months. That first half in early 2026. And listen, the market is hot. I mean, we're 22 and a half times earnings right now. We're trading at 19.7 times end of 2027 earnings. Okay, so the market is really it's expensive. Okay, but earnings are growing. Okay, I was looking at it this morning, and 2027 earnings. couple months ago were about 332, 333. They're up to 342. So we're really seeing acceleration on earnings growth in the coming years. We're seeing we had 2026 at 296, 297 just a couple months ago. It's up to 303. Okay? So we're seeing these revisions really start to move. Okay, and I think a lot of it has to do with not just AI, because there's a lot of AI spend, which of course would bring the earnings down. Okay, but it's a lot of the efficiencies now that are baked in to these companies. So what we're seeing is I think we're going to have 2026, 2027 is going to be a year of not a lot of top line growth. We're going to have a lot of bottom line growth because we're going to see some margin expansion that's going to take place. So, and Bank of America talked about that specifically, not so much of margin expansion because of AI, but they talked about we're not going to see, their 7,200 target for 12 months from now wasn't based on multiple expansion. It was based on solid earnings growth. Okay, so we have the fundamental underpinnings of a nice strong market. With some, like anything else, we're all going to get hit by the bus we don't see. Okay, so there will be some data point somewhere it's either good news, bad news, or it's a real bad news, and the market sells off a little bit, right? So, and that's kind of what I think everyone's waiting on. I haven't checked the AAII numbers, but I'm sure it's quite a bit more bullish than it was a couple weeks ago. But that's kind of been the story about this rally since, basically April, right? Everyone has hated this rally. Tom Lee says it all the time. This is the most hated V-shaped rally, and he's 100% right. I mean, it got to the point where I was at 6,300, call it just under 21,000 on the NASDAQ, where I said timeout on new dollars going in, okay? Just because it was getting a little stretched, and not that I don't believe in this market or I'm not bullish. I am very bullish. But, when you move that far, that fast, you kind of have to take a step back and say, okay, am I buying high? We want to buy low and sell high, not the other way around. But the market does have the fundamental side. It does have that fundamental attachment to it. So the momentum that the market is seeing is based on some very strong factors. So this is a great long-term secular bull market that we're seeing. I'm surprised there hasn't been some that's come in from anywhere, whether it's where the jobs report. Here's the thing. There's a very narrow window now for economic data whenever we get it, right? We don't know when we're going to get it because we don't know when the government's going to turn back on. But whenever we get those numbers, I'm going to be interested to see how the market reacts to it, okay? So if we get a very weak non-farm payrolls number, let's say we have consensus of 70,000, it comes in negative 70,000, okay? Well, that I think the market's going to have a real tough time with, okay? We had earnings revisions, right? We had payroll revisions. So the 12 month through March of March of 2024 through March of 2025, those revisions came in negative 911,000. Okay, so 911,000 fewer jobs were created than we thought were created in that year. That is the largest ever annual downward revision ever. Okay, June posted negative 13,000 on the non-farm payrolls. So August, showed up at 22,000 jobs. So we have an absolute real cooling, cold labor market right now. We're in a no hire, no fire. No one's firing, but no one's hiring. Okay. So what I think is going to happen is when we get that data, the data point where that's too cold, I think that's going to start signaling, okay, maybe the economy is in a little bit of trouble, because it's going to be hard to justify these stellar corporate profits if we don't have people going to work. Okay. So that's going to be difficult. I think the market will absolutely notice that. The other side is why it's such a narrow window is if all of a sudden the market, the job market takes off and reaccelerates, well, now all the rate cuts that are kind of priced in, which is, I think we have 5 rate cuts priced in between now and probably June of next year. That's my guess. 2 more this year and probably 3 in the first half of sometime in the first half of 2026. Okay. And I think
so what does that get us down to? What would the 3% by June of next year?
Yeah. So it would take us from the upper bound of 5.5 where we were before they cut last year to 4. And we stuck at 4.5 for most of this year. Now we're down to 4.25 on the upper bound. Okay. So that'll get us down to 3. Okay. and that's a good place. So it'll live between 2.75 and 3. Okay, so usually I'm getting call it 285, 290. That's not a bad place to be. That's neutral plus, right? Rather than neutral negative. So it's neutral, but it's not accommodating anything, and it's not restrictive, but it's not restrictive either, if that makes sense. It's definitely a heavy neutral number. So, so if we get, let's say everything turns back on, we have consensus of 70,000 new jobs created for September, and 170,000 jobs were created or something like that. Okay, all of a sudden that 10-year is going to go right to 4.25, right to 4.30, and the market's going to sell off. So there's kind of a tight window that the market needs to live in, as far as we need to be creating jobs, but we can't have too many or we can't have too little. So basically, it's like it's always been.
Yeah,
it's funny. When I wrote the newsletter, I said, we have the market has as much to be thankful of as it does to be watchful for, right? There's a big tug of war going on right now between earnings growth and earnings growth acceleration and a potential cooling labor market and kind of cracks in the economy, and we're starting to see cracks in corporate credit and things like that. So it's kind of like it always is. Yeah. There's always a tug of war. Which way is it going to go?
It's Goldilocks, not too much, not too little, just right, or not too hot, not too cold, just right. We've done. I think that was one of the title of an episode, the Goldilocks economy. So it's kind of back into that range again. I did a podcast yesterday actually with a guy who described the Fed. It was the whole episode was on the Federal Reserve, and he used the term soft landing, hard landing, or no landing. And he was kind of the mindset, I suppose, that he's not thought this, but he's starting to change his mind towards maybe there isn't a landing in this. Would you be? How do you feel about speaking to that on those three terms? So soft landing, hard landing, I think are pretty understood terms, but what about the concept of a no landing, that we just kind of, I guess, grow our way out of the money supply issue, if you want to call it that?
Yeah, that's what we've been kind of proselytizing here for the last 18 months.
He just said it better than we did then. He just compartmentalized it down into a term that I could understand, I guess. It's a no landing. Okay, gotcha.
I mean, the hard landing is obviously they kept rates too high for too long, and it's going to crash the economy. The soft landing is it slows it down, not getting into a recession or anything like that, but it slows it down enough. And no landing is we went from ultra hot to warm where it needs to be, and then we're going to kind of stay there. That would obviously be ideal. And that looks like, I think we're somewhere between a soft landing and a no landing. Time will tell, because right now it looks like we're headed toward a bit of a soft landing. Okay. And the labor market's the boss. We don't know yet. There's a few more months of this to work out, but there is a likelihood that we do grow our way out of this. Okay. Yeah. Because of margin expansion, companies will have more dollars to hire new people and do capital expenditures and things like that. So there is a lot of tailwinds that the labor market will receive. We do have we think we're going to have just a banner tax return year next year because of the tax cuts from this year. So that's going to be definitely positive for the economy next year. So we're getting some, although the monetary side has been quite restrictive, the fiscal side is quite accommodative right now. So I think it might be that fiscal stimulus that we're receiving, that Americans are going to receive through tax cuts and things like that, and like no tipping, no tax on tips and things, whatever, that I think are going to be a big part of the earnings expansion and a big part of the economy not landing hard or soft, just kind of slowing down a little bit, coming from the ultra hot times of 2020, 21 and all that high inflation to something that's sustainable. So 2.9% of top line core PCE is okay. I think it's slowing down. I think the labor market will bring it down to where it needs to be in the 2.5 range, and 2.5% core PCE. We're starting to see GDP revisions up again. I think we have 1.8% for 2026, which is up from 1.6. So, we're still seeing a little bit of a delta between where inflation is and where GDP growth is. So I think a lot of that might be, I think some of that might be attributable to the tariffs. Okay. But again, it's not inflation. It's a price level change because of a tax. It's not a supply demand imbalance.
I'll tell you what, I know this has nothing to do at all with anything that we're talking about, but I don't think you can see this. I think on your screen, you can only see me. But for the viewers out there that are watching on YouTube, I apologize for switching around. For the longest time, I've had 3 options for the views that I can put on the screen, and I log on today and I've got 7 different grids in different ways. I can put you in the big center thing with me in small on the right. I can put a side by side. I can put a side by side with me a little smaller. If you're watching on YouTube right now, I'm probably making you dizzy because I just keep switching back and forth. This is so cool to me, how many different things I can do. And I didn't know I could do this when we logged on. So I'm just like a kid in a candy shop right now trying to figure out which of these views I like more. So if you're watching on YouTube, I apologize.
No, it looks good. And the logo on the back has stayed put this time. It looks great.
Yeah, it's holding up very well. So before we got started, sorry, I ADD derailed us there. Before we wrap up here, because I know we got to go, but you talked about how you were right and you were wrong, or we were right and we were wrong. It had to be we were right, you were wrong. I'm not taking any credit for the wrong. I didn't have anything to do with that. But I'll take credit for the hits. I'm not taking any credit for the strikeouts. So explain that just a little bit. I thought that was pretty cool.
So it looks like we were right. We've been saying all year long, 3 rate cuts. We're going to get 3 rate cuts this year, 3 plus or minus 1, right? So 2 to 4, but 3 was our base case. And especially back in May, when we had some little, some hotter inflation numbers, things like that. No rate cuts. We were down to no rate cuts. Maybe 1 if we're lucky in December. Why is the Fed cutting at all? The economy's doing fine. Blah 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 blah. And now everyone's coming on board, and now there's an 87% chance of 3 rate cuts this year. So we got that one right. And that one, it's kind of, does it matter? No, not really. But I think it helps to let people know directionally where yields and markets are headed. And it's that rate cutting schedule and yields coming down that I think is a large part of taking the market where it needs to get to, that 68, 69, 7,000 range by the end of this year. It was a ground ball to third, and I got thrown out on this one. Because we stopped, like I said, I kind of stopped allocating new dollars right about 21,000 on the NASDAQ. So, and I was thinking, it will probably bleed up a little bit, maybe another 4 or 5, a couple percent from there before there's some sort of meaningful pullback that we normally get into your August, September, October timeframe. So when I look at my technical tool called DeMark, which is great, that's showing kind of on a weekly basis that if we get sort of a pullback, it's going to be the back half of October. I was like, the market just went too fast to wait that long. I wonder if DeMark is going to, if we're going to get what they call a disqualified up or something. And nope, it's right on. It seems to be right on. So sometimes we talk about trusting your data here. And I decided to not trust my data. And so here we are. But, here's the thing is the market's a funny thing. People say, so did we miss out? No. The market will send us back in time. The stock market has a DeLorean, and it will send you back in time very, very quickly. Opportunities will always show up.
Yeah. If you're waiting for a pullback, you'll get one at some point.
Yeah.
So, all right. Well, I know we got to go. So I'll just wrap us up here. The Intelligent Investment Show is for entertainment and education use only. Do not do what we say just because we said it. If you would like to talk to an investment professional, you should give Matt a call at 702-6. Good Lord, tell your number. I don't have it pulled up today. I should have it memorized.
702-655-8300. We have a wonderful staff and advisors here who will be happy to help you.
There we go. I've said it so many times, I took it for granted. And I didn't even pull it up. I thought I had it off of memory. And then as soon as I said 702, I drew a blank. I didn't know what came after that. So I will let you get back.
Mike, the Jersey.
Oh, yes, the hot honey. Yeah, you said you tried it.
I did. It's solid. I said, no, get it out. So the recommendation on Uber Eats was the Parmesan bread with it.
Okay, I hadn't tried that one.
So I got the Parmesan bread instead of the regular bread. Dude, I mean, it was like, it was.
So on your hot meter, how hot was it to you on a hot meter?
Oh, it wasn't that spicy. I mean, it had a nice kick to it. Don't get me wrong, I loved it, but it wasn't like, it wasn't one of those like somebody sneaks a habanero pepper into your sandwich.
So I'm saying this on like a scale of like the hottest thing I've ever consumed was a ghost pepper hot wing challenge, and that was as close as I've ever experienced to hell in my mouth. I mean, it was awesome.
I was going to say that sounds like death.
That was rough. Well, I mean, it was one of these, like, you know, let's just see if we can do it. I mean, you had to sign a waiver before you did it, so that should have been a warning, you know.
Right.
But I made it through, I think, 2 bites of the 6. I mean, so that was pretty brutal. So that is kind of my highest level that I could go. But I would say, like, I went into the Jersey Mike's Hot Honey expecting like a solid 4 or 5, like a little. I did feel like it was more 7-ish, not like I'm dying here, but it was more than I expected.
It had some kick. I was going to say it was about a 5.
Yeah. Okay. All right.
But
all right.
One of these days we have to get together and we need to benchmark what a 10 is. Actually, you know what? We're going to benchmark what a 5 is.
I'm not touching a 10 again. Yeah, I'm not touching a 10 again. No, I'm good on that. I've found my limit. We can benchmark a 5 though. That sounds fun.
We'll go to like Buffalo Wild Wings or something.
Yeah. Usually if I go to somewhere like that, I can usually go to the hottest thing on the menu and I'm okay. Usually I can handle that. I mean, it's got some kick, but I can usually handle it. But that ghost pepper was no joke. I'm not gonna lie.
It's like a purple color, right?
I don't even remember. I think I blacked out after I think it was one of those things where, like, after I did it, I don't remember it anymore.
I mean, we were like sweating and tearing up and.
Oh yeah. I mean, it was like, I think they give you milk isn't milk better than water?
Yeah.
For those substitutes. I mean, they had milk there for that purpose. So I was drinking milk, and yeah, I mean, it was, well, I'll put it this way. The next day when I would have, like, we'll just call it indigestion, I was burping this stuff up for like 2 days and could still taste it. It was, and this was from 2 bites. Again, I didn't eat the whole thing. I had 2 bites and I could still feel it 2 days later. It was nuts. So anyway, all right, my friend, see you next week. Enjoy your weekend. All kidding and jokes aside, it is a glorious and blessed time for the family. So I hope you have a great time. Enjoy the time, and I will talk to you next week.
Thank you, sir. I will talk to you next week.
See ya. Bye. Discussions in the Intelligent Investment Show are for educational purposes only. The information presented should not be considered specific investment advice or a recommendation to take any particular course of action. Always consult with a financial professional regarding your personal situation before making investment or financial decisions. The views and opinions expressed are based on current economic and market conditions and are subject to change. There is no guarantee that any statements of future expectations will come to fruition. All investing involves risk, including the potential for loss of principal. Securities offered through United Planners Financial Services, member FINRA, SIPC. Advisory services offered through American Retirement Planning Group, ARPG and United Planners are independent companies. Garrett Lill and Wealth Partners are not affiliated with ARPG or United Planners. Any endorsement that I may have given during this recording, it is important to note that I am not a client of ARPG. The views expressed should not be considered representative in any way of my past, present, or future experience with Matt or ARPG. No incentives have been provided to me in connection with any endorsements I may have given on the Intelligent Investment Show. Investing involves risks, and there is no guarantee of any future results, performance, or success.